On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi, everybody. Thanks for joining me and tuning in. Much appreciated. Let's look back at last week, then we'll turn our attention to the very, very busy week that is coming up. A mixed bag across the world for equity markets last week. We had the US S&P 500 lower for the second week in a row after stronger inflation figures saw Treasury yields rise and a bit of nervousness crept in ahead of this week's Federal Reserve meeting. The Japanese market also down a little more than 2%. Likewise, the Australian market and emerging market shares also off ever so slightly. The UK and Europe bucked the trend. There were some small gains out of those parts of the world, and the local NZX 50 finished the week 1.3% lower. So most regions were slightly lower last week to varying degrees. I think that's probably to be expected after a pretty strong run. You know, we're not quite 3 months in, but the US market is up more than 7%. Japanese shares are still the star performer. They're up almost 13%. Europe's up 6.5%, emerging markets and Australia up about 1%, New Zealand flat, the UK flat. But by and large, most of those markets out there have performed pretty well after a reasonably buoyant 2023, in some cases very buoyant in the cases of the United States, Japan and Europe. So understandable that you will get some volatility that will creep in after such a strong run. US interest rates were up. The 2-year Treasury yield rose from 4.5 to 4.7. The 10-year rose from 4.1 to 4.3. Likewise in New Zealand, although not to the same degree, our interest rates were up, but only slightly. Market pricing in New Zealand still points to August as being the most likely timing for the first OCR cut this cycle. So that's still something we're keeping a close eye on. Looking back at the key data releases last week in the US, it was inflation, the February Consumer Price Index report, and like January, it was a little hotter than expected. The headline CPI was in line with expectations, although core inflation was a little stronger. And when you look at the annual inflation rates, headline CPI tracking at 3.2%, that was actually slightly above forecasts for 3.1%. And the core inflation rate, it slowed, but it didn't slow quite as much as people were expecting it to. So it came down to 3.8%. But it was expected to come down a little bit more than that. And when you look at what they call supercore inflation, which is the price of services excluding energy and housing, that's running at an annual pace of 4.3%. And that's actually the highest we've seen since May 2023. So that did just cause a little bit of nervousness across the US market because you've got the Federal Reserve coming up this week and people are starting to think, well, maybe they will have to keep interest rates a little bit higher for a little bit longer. So we'll talk about that shortly too. We had the housing market report here in New Zealand, the February Real Estate Institute report. That did contain a few positive trends, which is good. We've seen a slow start to the year, but February was definitely a better month. Nationwide sales volumes were up. Again, off a very low base because January was a pretty terrible month. So you probably can't read a whole lot into that, but still other signs that things are improving. Prices were up slightly too. So the last 9 months, 8 of them have seen gains, and we've seen a rebound of about 5.5% from the lows that we saw in May 2023. However, even though prices are still almost 14% below the peak, which came in late 2021, prices are still 27% above pre-COVID levels. So affordability is still an issue. And I think that is something that is going to hold the market back. I suspect house prices will push higher, but I think the gains might be a little more modest than you've seen in other cycles because the starting point is still quite high. I did record a podcast about the interest deductibility changes. So go back and have a listen to that one if you want to hear my thoughts about what those changes might mean for the property market and where I think prices might be going and some of the headwinds and tailwinds that are likely to be in place for the housing market over the next little while. Right, turning to the week ahead, and it is a big one on the central banking front. We will have monetary policy decisions coming from Japan and Australia on Tuesday, and then in the US and the UK later in the week. So that US Federal Reserve decision will be the main event. All eyes will be on the Fed, especially after last week's hotter than expected inflation figures. Investors are really going to hone in on the latest projections and the dot plot, which is where we'll see how Fed officials see interest rates developing over the coming years. So the outcome of the Fed meeting will be released at 7 o'clock on Thursday morning in New Zealand. The meeting will take place on Tuesday and Wednesday in the US. We'll get the outcome at 7 a.m. on Thursday. That will be followed by a press conference with Fed Chair Jerome Powell, and anyone who wants to see that will be freely able to view it. It's almost certain that the next move from the Fed is down. We just don't know when that will quite be. It won't be this week. At the moment, markets see the most likely timing for the first cut this cycle as being June. And current pricing implies about a 60% chance of a cut in June. However, those odds have fallen over the last week or two. As you've seen those inflation reports come in a little stronger than expected, markets have second guessed whether June is too early, and maybe you'll see something later in the year. So if you had to put money on it, you'd probably still put your money on June, but you might not put quite as much. We'll be watching the summary of economic projections, as I mentioned, and if we think back to the last one of those, which came in December, it suggested that the Fed would cut rates 3 times during the 2024 calendar year, so 3.25% rate cuts. And investors will be watching to see if that's changed, to see if the Fed has been unnerved by some of the inflation pressures that you're seeing and whether they've pared back those forecasts for 3 rate cuts to maybe just 2. So we'll wait and see. Thursday morning, that will be really important. Earlier in the week, there's another really important central bank meeting, and that is the Bank of Japan. This will come out on Tuesday afternoon, and it's shaping up as a very interesting one because the Bank of Japan hasn't increased interest rates like most of the other central banks around the world have. They still have a negative policy rate. They haven't moved it at all, and they're still putting forward policies that are very stimulative, yield curve control, keeping interest rates right across sort of all maturities of government bonds low. So they still very much are putting the foot on the gas in terms of providing stimulus to the economy. But that is going to have to change because inflation has increased of late in Japan, which is a good thing. That's what they've been trying to achieve. And also, Japan's largest union announced stronger than expected annual wage deals on Friday. The annual wage deals have come through at 5.3%, which is the biggest pay hike we'll have seen in 33 years. And as we all know, and as we've seen in places like New Zealand and the United States and everywhere else in recent years, wage growth is fantastic for workers, but it does lead to inflation elsewhere. So that could have changed the landscape for the Bank of Japan, and it's possible that they might make some changes to that negative interest rate policy or some of the other things they're doing as early as this week. Maybe not. They might wait until April, but it is imminent. It feels like it's not far away, and that could have wide-ranging implications for the Japanese yen, and obviously for the Japanese equity markets, which have been performing very, very, very well, and it could reverberate around the world in a range of other ways. So that one will be very closely watched as much as the Fed, to be honest. Later on Tuesday afternoon, we have the Reserve Bank of Australia meeting, and their decision will be out at 4:30 in the afternoon. They're unlikely to make any changes this week, although like many of those others, Japan aside, the RBA is expected to cut rates in terms of the next move they make. So we don't know when that'll be, just like we don't with any of the others, but like the Federal Reserve, markets are looking at June as the most likely timing. So it will be a case of watching the language, watching the tone, listening to the way they talk to get a sense for whether that is a reasonable expectation or whether it will be later than that or sooner than that. There is a small chance they'll do it this week. Probably not, but there is a small chance that that'll happen. Rounding out the four big central banks will be the Bank of England, and this will be on Thursday evening. They won't make any changes this week, but I am interested to see what they say and what they do and what the votes look like, because it was really interesting the last time the Bank of England met. They left interest rates unchanged and they voted 6-3 in favour of doing that. Although it was really interesting to look at how those three votes went in terms of the three that voted for something else. Two members voted in favour of another hike, and one of those three voted for a cut. And that's not something you see every day. The last time we saw members of the Bank of England Monetary Policy Committee vote for moves both up and down in the same meeting was way back in 2008. So that was pretty interesting last time. UK inflation is a little bit stickier than we're seeing elsewhere. It's sitting at 4%. We'll actually get some new figures on that too this week, but sitting at 4%. So higher than the United States, higher than Europe. And that is maybe something that will keep the Bank of England from moving as quickly as some of the others. So market's still a bit unsure about when the Bank of England will make a move. Might not come as quickly as we're expecting a move from the Fed or the Reserve Bank of Australia or the European Central Bank for that matter. It might be sort of August. It might be similar timing to what the Reserve Bank of New Zealand eventually does. Flash PMIs for March will be the key economic release, in my opinion. These will be out on Thursday, so we'll get the Aussie measure at 11 o'clock on Thursday, the Japanese one at 1:30, and then the UK, Europe, and the US will follow overnight. PMI stands for Purchasing Managers Index, and these are essentially activity indicators, so they give you a good feel for how economic growth is tracking. Last month, February, they were pretty good. January were also pretty good. So they have reflected a pretty solid start to the year for most of the major economies, although inflation measures and indicators haven't been quite as encouraging. We've seen a lot of variance. In the US, we've seen cost pressures easing, but in places like Europe and the UK, they've been lifting. So we'll be watching the PMIs late in the week to get a feel for how economic activity is tracking in all of those major regions. And we'll also be looking at some of those inflationary indicators too. On the local front, there's a couple of things to watch. Another dairy auction early Wednesday morning. A fortnight or so ago, we saw the headline Global Dairy Trade Index fall 2.3%. That was the first decline that we'd seen since November. Since then, we'd had a string of 7 consecutive auctions where prices went up, and the gains accounted for about 13 odd percent if you put them all together. The headline index is still higher this year. It's still up about 6%. It's still about 28% above the August 2023 lows, but we don't want to see prices drift back too much further. So a bit of stability would be good. That will be on Wednesday morning. The next day, Thursday, 10:45 a.m., we will get the gross domestic product report for the December 2023 quarter. And this will be interesting because the last 4 quarters, I should say, 3 of them we've seen GDP contract. So the economy has gone backwards, which is even more disappointing when you remember the fact that population growth over the last 12 months has been very, very, very strong. It means on a per capita basis, we've gone backwards even more than those numbers suggest. So the Reserve Bank is forecasting GDP to be unchanged for the quarter. The economic community is a little more upbeat. They see a gain of 0.1%. But it'll be interesting to watch because this might have implications for what the Reserve Bank does next with the OCR, and when they do it, you get a much weaker result. It could firm up those hopes that we're going to see a rate cut in August, or if you get a stronger than expected result, maybe it will delay those expectations. It's kind of old news. This is the GDP report for the December 2023 quarter, of course, so it'll cover October, November, December last year. Give it a couple of weeks and we'll be in April. So it's starting to feel a little bit dated, but it will get a lot of attention, and it is something that markets and investors and the business media will pay attention to. Outside of that, there is the Aussie Labour Force report that is out on Thursday. I think it'll be 1:30 in the afternoon that comes out. Unemployment across the Tasman 4.1%, so a little higher than it is here. Not expected to change much, so that's something we can keep an eye on. And there's also a few things on the corporate calendar. We've got a few of the retailers still to report. So this week we'll hear from KMD Brands, which is Kathmandu. Their interim result is out on Tuesday. The Warehouse reports its interim result on Wednesday. We've also got Fonterra, not a retailer obviously, but still a big company that we follow. Their result is out on Thursday, and when we look further afield, there's a few things to keep an eye on at a corporate level. Tencent, the Chinese tech company, their result is out on Wednesday. That'll be a quarterly. And on Thursday, we will have Darden Restaurants, FedEx, Lululemon, and Nike. All of those interesting for different reasons. FedEx considered a bit of a bellwether for the US economy, and you always learn something about what is happening out there when you dig a little deeper into the FedEx result. So there you go, four big central bank meetings, a New Zealand GDP report, and a few things to watch on the corporate calendar. All right, thanks all. We'll talk again soon.